All right. Hey, everybody. Thanks so much for joining us for our live Thursday webinar. I am joined today by a very special guest. We are joined by Dino Champagne. She is our go-to 1031 exchange facilitator, and she is here to teach us her top 5 pro tips for how to execute a successful 1031 exchange. It is no secret, a lot of our investors have realized incredible equity gain in their real estate portfolios over the last couple years. And so many people are asking themselves, is now the right time to capture that equity gain? And then they realize, wow, I'm going to have to pay Uncle Sam a big chunk of that. And naturally, one exchange conversation begins. And it can be kind of overwhelming for people who are maybe pursuing their first 1031 exchange, which is why we connect with awesome people like Dino to help make that process more demystified and a little more seamless. And so, Dino, we're grateful to have you here sharing your wisdom today.
Well, thank you for inviting me. I appreciate it.
Now we'll get through some housekeeping items real quick before we jump right in. So our disclaimer, the strategies we're going to talk about today might not be appropriate for everybody. There are other options that we won't discuss that might be more suitable for your specific situation. So as always, you want to consult your own personal accountant, tax advisor, and or attorneys to discuss your specific situation. Obviously, we're talking about tax related information, but Dino is not a CPA. So you definitely want to consult with your own experts to see if the 1031 exchange strategy even makes sense for you. Past performance is no guarantee of future results. Real estate purchases are, of course, subject to investment risks, including the possible loss of total amount invested. So while we are making every effort to maintain accurate and current information, we're human, and the possibility of errors and updates is always a potential. So keep that in mind. You're still in the driver's seat of your own due diligence. Okay, so we have Dino come on. I feel like every 6 months or so, we get you in our cycle so that we can get a basics class of fundamentals on, what is a 1031 exchange, what are the timelines, what are the identification rules. This webinar is not going to be a 1031 exchange 101 class. However, we have the recorded class that we just did previously with Dino on our investor portal. We are recording this webinar like we do all of our webinars, and we will archive it right next to the in-depth 1031 exchange class that we did previously with Dino. So if you're watching this on our YouTube channel, or if you're watching this on the investor portal, you can always navigate to Dino's page under resources. You'll see her listed there under 1031 exchange facilitators. She'll have her contact information there, and then you'll see there's an education tab that you can pop open, and you'll see the full archive list of all the previous webinars we've done with her. So just getting that out there. We will have a designated time for Q&A at the end of this webinar. So we'll certainly entertain any questions that you have on 1031 exchanges. But if you are like, I need the basics, the 101 on 1031, start first with that webinar in her archive list. Okay, so Dino, you are our go-to for so many reasons. How many years have you been affiliated with RealWealth? How many years have we been connected? Do you know?
Oh, I'm really not sure. I want to say probably maybe 7 years or so, but I've been doing this for 20 years. So I want to say maybe like in the mid 2000s, somewhere around there. I can't recall. Everything seems like it's just constantly, time's moving very, very rapidly.
Well, I think it's safe to say you've probably worked with hundreds maybe of RealWealth's investors over the years.
Yes.
I always talk to investors first when they're first kind of contemplating this idea of 1031s, and it feels very overwhelming. And I always ease their mind by saying, look, we've got a great contact who can really facilitate this process for you. And I can't tell you how many times people come back to me after their first conversation with you, and they are like, oh, okay, like this is not as chaotic as it seems. Yes, there's some timelines that make things a little bit stressful, but there's people out there who this is just another day in the office. So you've been that go-to for us for many years. I would love for you to kind of introduce yourself to our membership for those people who aren't really familiar with you. Tell us what's got you into this.
Interesting. Prior to joining Asset Preservation, which is a national 1031 qualified intermediary facilitating exchange, I've been with the company now 20 years. I used to be a commercial broker, and I was a commercial broker for 14 years prior to coming to API. And I just wanted a change. I wanted something different. I got tired of the commercial brokerage industry. And so I sort of very serendipitously fell into doing this 1031s. So it's been a fun ride. What I love about it is every day is different, and you learn something new every day doing this job, because there's always nuances to every transaction. So it's fun. It's definitely not boring. It's definitely not boring. So that's kind of how I got into this, very serendipitously.
And you're a real estate investor too, right?
Yes, I am. Yes. Yes, I have real estate investments. Most of my stuff is in Florida. And so, you know, I've done my own 1031s, which were challenging because I have to still meet the same time frames as everybody else. So I don't get any special privileges because I'm in the industry. So yes, I have investment real estate, yes.
Wonderful. Everybody seems to really like the fact that you're in California. So a lot of our investors are in California doing big 1031 exchanges out of California into markets like Florida. And so they connect with someone like you, and you guys just have a lot of synergy so often. Mm-hmm. So
excellent.
All right. Well, I am going to let you take it away and jump into these 5 pro tips that you've put together to help us kind of avoid some of the pitfalls of 1031 exchanges. I will monitor the questions as they come in, Dino, and if they're relevant to the pro tip that we're on, I'll pop on and we can have a conversation about it. But again, for our viewers, pop open that question panel and interact with us.
All right, very good. Thank you, Leah. Yeah, I mean, today's program is basically to go over some of the 5 top things that I think is very, very important to try to have a successful 1031 transaction. So I'm going to take, break out each one. So we're going to talk about consulting your CPA, about the 1031 process and consulting the qualified intermediary, becoming familiar with the process, confirming certain items such as tax ownership, and then communication. So these are the 5 top tips that I feel that are very, very important to try to have a very successful 1031, because it can be a challenging transaction, that's for sure, from time to time. So let's go to the big one, which I think is so important. Anytime that you're considering selling investment real estate, I think it's so important that when you're considering selling that property, that besides your real estate professional and your investment counselor, you should also be speaking to your tax advisor. Tax advisors, they put them in the back of the line, and in my opinion, to have a successful 1031, they should really be at the front of the line, because that's the party that's going to be able to explain in your transaction that you're thinking about possibly selling. Do you need to do a 1031, or should you be doing a 1031 based on your tax ownership and your tax situation? See, when you're talking to the qualified intermediary, we don't know what you've got going on your tax returns. So there's certain items that may come into play when you're having this discussion about selling investment property, because maybe you're in an income bracket where the passive losses that you have may not have been written off against your ordinary income as you're operating the property during the tax ownership. So in those instances, you may have some loss carry forwards. If you have loss carry forwards, we as a qualified intermediary, we're not going to know that. And if you get a chance to utilize that against any gain, that's a positive. Okay, there are some instances where that becomes very important, where the taxpayer doing the exchange doesn't need to do an exchange, or the taxpayer should say considering an exchange does not need to do one, because they have enough losses to offset the gain on the sale of that asset. So the only person that's going to be able to let you know whether that's viable in your transaction is going to be the person that does your tax returns. So it's very, very important to talk with that person and then find out, do I need to do a 1031? Should I do one? If so, do I need to do full deferral? Can I do a partial deferral? So they play a huge role, I think, in the success of any 1031 transaction. The next thing that the tax advisor is so important on, and that's reviewing the closing and the settlement statements. We get questions all the time. It's like, well, what expenses do we get to write off against this this transaction? What expenses count for the exchange? All these items are very important because the tax advisor may view certain things that are on the closing statement a little bit different than maybe we look at it. So there are certain exchange expenses that are very, very straightforward, such as commissions, paying the closing fees, paying any transfer tax, the qualified intermediaries fees. So there are certain fees that are very straightforward. There are certain items on the closing statement that may not be. So when you're doing a 1031 to keep it successful and to make sure you're trying to maximize your tax deferral, have your tax advisor review the closing statement for the property that you're selling, and especially the closing statement for the property that you're buying, because there are items on these statements that end up coming into play. Those are that is the party that's going to be able to explain to you, no, I think you should bring in the money for that. No, I think we can write this off. Okay, this is not something we as a qualified intermediary can tell you. We don't know what your accountant's going to do. So to help to facilitate the exchange and help be more successful, really important to make sure that you're keeping your tax advisor in the loop of what you're doing before you sell something, during the transaction, all through the end, because that's the party that's ultimately going to file your tax returns and report the 1031 of the transaction that you just got finished doing. So again, one of the biggest tips, and that's why I put it as number one, make sure that when you're considering selling investment property, that you're consulting your tax advisor to give advice. And then if you're going to be doing an exchange, to be reviewing the closing statements, both the sale closing statement and the purchase closing statement. They are very key to helping you minimize any tax liability. So that's a very big one. So the first thing, get your tax advisor involved. If you have a tax advisor that's not familiar with 1031s, it may be time to start looking for one that does understand 1031s and understands real estate. Okay, and I think Leah probably agrees to that one.
Yeah, I've got a clarifying question, Dino. I'm
Sure.
glad you mentioned about the timeline, because that I think can get kind of confusing as far as, okay, I know I need to engage with a CPA, and you mentioned it's not just don't plan to engage with your CPA after closing when everything's done. You have to be doing things in advance, during, and then of course after.
Definitely, yeah, because if you're already after the fact, then what you're going to do now? I mean, you've already put everything in motion. There's certain things you can't stop. So yeah, definitely ahead. When you're getting ready to sell the property, to me, is when you talk to the CPA. And fortunately, we're out of tax season, so that makes that a little bit easier. It gets really tough at the beginning of the year. I like to say once February hits, and I tell people to go talk to their tax advisors, now we're going, uh-oh, because they're very, very busy during their tax season. So it can be challenging at times. All right, but you have to make your position known, and you want to make sure that they're helping you through all of this.
Yeah. In my case, Dino, I came to after consulting with my CPA, I know I exchanged some emails with you, kind of trying to figure out, like, does a 1031 make sense? As you mentioned, I had enough loss carrying forward that my CPA felt like the tax bill was going to be kind of inconsequential. And something that she told me to consider, and I know that you do as well, is like consider the transaction cost of a 1031. I mean, you do pay some additional fees to your organization for all the help too. So you have to ask yourself, like, okay, I pay a tax bill, but then are the expenses of doing the 1031 justified in addition to the time constraints? In a market like this, you might be willing to pay a little tax.
Exactly. I mean, sometimes you do have to, yeah, I call it, to pay to get off the off ramp, and then you can just sit back and then take your time. So that's why I tell people, if you're considering an exchange, when you talk to your tax advisor, you may not need to only do a 1031 if it's going to benefit you. Okay. If it's not a beneficial transaction, then don't do it. So you want to just make sure that it's going to be beneficial tax wise, along with everything at market conditions. All right. These are all part and parcel to the transaction.
Right.
All right, now the next important role in the 1031 is going to be the role of the qualified intermediary. Now, the term qualified intermediary actually means, that's the legal term because that's part of the tax code. So we're known as a qualified intermediary. Some people refer to us as accommodator or facilitator. It's all the same thing. Now, it's really important when you're considering selling the property, you talk to your tax person, then the next person you should be speaking with is the qualified intermediary. So the role of the qualified intermediary, we're going to basically sit down and, as you know, I'm going to explain to you. So if you're calling me, I'm going to say, okay, let's talk about your transaction. If you sell the property, how much are you looking at selling it for? All right, do you have any loans on the property? So these are going to be some specific questions that I'm going to be asking. What I'm going to do at that point, now I'm going to take you through the process of the exchange. And then, you know, like Leah said, if you want to know more about the details, more details to the process, you know, just look at the other webinar that was done. But I'm going to take you through the process. I'm going to explain, you know, what the role is, what happens next. So the rules, the timelines, how much money you have to spend. So we're having these conversations. We're talking about replacing the debt that you may have on the property. And then we'll get in conversations where sometimes I'll have people that really like to utilize leverage in a transaction. And leverage is a good thing, but when you're doing a 1031, you have to be very careful because you have to, I like to say you have to keep your eye on the prize, all right? And what is the prize in a 1031? Tax deferral. So there may be instances where an investor may say, well, I've got all cash because I had no loan on the property I sold. So now I want to go out and get, you know, 75% financing on the new property. Well, when you're doing something like that, now we have to look at, and this is part of the conversation with the qualified intermediary that, you know, I've had numerous times where somebody says, for example, I have $400,000 of cash that I can put down. And then they go, I want to put down 25% on each property. Well, when you think about that kind of leverage at 25% down with $400,000 of cash, theoretically, you can buy $1.6 million of property. Sounds great, right? Now you're going to come up against the identification rules in a 1031. So these are the things that the conversations that we're going to have. So, you know, every transaction is specific. So that's why it's important, you know, when you're doing your own transaction, you have your conversation with the qualified intermediary. You can talk to your friends, that's fine, but the qualified intermediary is going to take you through what they see every day, you know, and every month and every year. So I would caution somebody that's selling a property that, you know, has $400,000 in cash with no loans on it. That tells me their sale price is not that big, right? It's probably about $430,000. You're going to be in the 95% rule. So that's a very dangerous 1031 rule. So the role of the qualified intermediary, I'm going to take you through the process. We're going to go through the guidelines, how to identify, what you need to identify. What are your next steps? This is one of the things that's so important in the 1031, and people, you know, that have not been through this process before may get a little bit confused. So what do I do next? When do I engage the qualified intermediary? So when you talk about doing an exchange and you've got the green light to go forward, when we're going to say next steps are going to be contact, when you're in contract with a buyer, that's when my role actually officially begins. We have to have a contract that we can be assigned into. So once you get in contract with a buyer and then you open up escrow or you have an attorney handling it, whoever's handling your closing, that's when we get involved. We have to prepare the the relinquished property exchange documents. So we need copies of contracts and such. We'll explain to you that you have all these documents coming in from your sale. You have the documents coming in for your closing. And then I tell people, brace yourself because you're getting a whole nother set of documents. So what steps are going to happen next? I tell people you're going to be getting documents from us. Our exchange documents have to be signed prior to the closing of the sale. Then we wait for the sale to take place. The funds come to us. Then what happens next? Now you're out making offers on properties. Once you make an offer on properties and get in contract, you have to let the qualified intermediary know. I know that sounds silly, but there's so many times where buyers and sellers are off doing their thing and they get in contract and then they forget to call the qualified intermediary. Let me know, oh yeah, by the way, I'm in contract with something. we have to prepare those documents as well. So, understanding what the next steps are, what to expect in the transaction. So when we have this discussion, that's what we're going to take you through. We're going to explain to you what the first step is, the second step, the third step, the fourth step, the fifth step, however many steps it takes to get your transaction completed. So if you want a successful 1031, talk to the CPA, talk to the qualified intermediary. We're having two separate conversations, but both conversations are extremely important to the success of the 1031.
Now, Dino, I'm imagining that not all qualified intermediaries are created equal. My hope is that everybody would work with you, of course, because we've vetted you and we know you and we've seen your success rate. But I mean, what should people be careful for or cognizant of when selecting a qualified intermediary?
Excellent question. The 1031 industry is not regulated at the federal level. So there's no regulation for qualified intermediaries to do what they do. There are certain states that require licensing, but at the federal level, we're not regulated. So when you're considering a 1031 company to facilitate the exchange, to me, the two major things. One, what is their experience? So how many exchanges have they facilitated and how long have they been in business? And they probably, I should have been first, but it's now second. And this answering your question is, what is the financial backing of the 1031 company? Are they backed by a larger company? So where do they place the funds? Do they place the funds in segregated accounts and, separate from the operating? So those are good questions to ask the qualified intermediary. How long have you been doing this? How many have you done? What is your financial backing? And then, basically where you place the funds. So because we're not a regulated industry. So it's very important. It's not just the cost of doing the exchange, it's the rest of it that comes with it. So yeah, and how fast can you move? How big are you that you can get stuff done? So yeah, very, very good question. So, all right, now the next thing that's one of the is important for the success of an exchange is become familiar with the requirements. All right, so this is like when you talk to a qualified intermediary, so somebody like me, I'm going to take you through the process. You're hearing the information sometimes maybe for the first time. Well, how many times have we sat and listened to a lecture and we walk out of and we listen to the lecture and we think we got it all, and by the time we get to the car, we've lost 80% of what was said. I agree that I've done that to myself. So start to become more familiar with the process. You're going to need to understand the role of this. So it's going to take a little, studying and getting familiar with everything. How much do I have to spend for full tax deferral? Even 1031s have been around for over 100 years now. And, I facilitated thousands of exchanges. Our company has facilitated over 200,000 exchanges nationwide. But people still don't always grasp how much you have to spend for an exchange. We explain it, and then people talk to their friends and they get a different opinion. So understand what's full tax deferral. See, when you're doing an exchange, it's not just the cash coming out of the closing, nor is it just the gain on the sale of the property. When you're thinking of a 1031, it's the cash that's coming out and the debt that you had on the property. Those items have to be replaced. Your basis moves with you to the next property. So understand what is required. So that way you're not making any mistakes by thinking, all I have to do is spend the cash, or all I have to do is, replace the gain on the sale of the property. And people will think this in the middle of a 1031 transaction. So it's because they're not familiar with it, but you need to take time to learn what you need to do. And there's a lot of time people that do transactions want what they want, but you're involved in a tax transaction, so you don't always get it your way. You have to comply with the code. So just understand what is required for full tax deferral. A huge one in the 1031 being successful is understanding how to properly identify the replacement property, because these are items that are critical to the success of the exchange. Properly identifying the replacement property or properties will make or break your exchange. Know when you have to identify. Know when that date falls. Know what forms you have to fill out. If you get confused, talk to the qualified intermediary, get more clarification. Again, this is all new to a lot of people that are doing this for the first time. Sometimes people think, well, I'm in contract with the replacement property, so I'm good. You're not good if your purchase is going to close after that 45 days. You still have to formally identify the property. If you don't formally identify the property, is it considered like kind in a 1031? Those are the issues. So understand about the identification. How do I have to identify? Just as an example, I had a transaction this month, and the person they wanted to identify early. Their ID is not due until next week, but they wanted to make sure they got that ID form in. They filled out the ID form. They were missing some information like the city or the state. I can't remember which was. Then we said, oh, you got to fix this. So we had to revoke that list, and then she had to replace it. Then comes back again, a second time, a third time, the fourth time it was right. All right, and what I mean by it was right, because she had all the address, the city and the state was there. She was identifying under the 200% rule. The dollar amounts were there. It was added up accurately. She signed the form, dated it, and so that was good. But that was an example of 4 chances. Now, fortunately, she was doing this long before her ID was officially due. Sometimes we have people that wait to the last minute. When do you have to send it in? By midnight of the 45th day. So people go, well, I have till midnight. They'll send it in at 11:30 at night. While they got it in on time, did they do it right? And there are examples where people do not. They end up putting themselves, they end up identifying more properties than they should have, or they forgot to put the city or the state in the ID, and you can't fix it after the 45th day. So truly understanding how critical the identification is, and the timing and how you have to get it in is going to add to the success of the 1031. Because one thing I want to just make very clear, whatever addresses you write on that list that's the only property you can buy in the 1031. You cannot change that list after the 45th day. So as you can see, understanding and becoming familiar with how much I have to spend, and then how to identify properties will add to the success of the 1031. Now here's one that has become, let's just say, epidemic, and that is your tax ownership and the vesting. And when I use the term vesting, for people that may not be familiar with it, it's actually how you're showing on the title to the property, whether it be a warranty deed, or a grantee, however, whatever state you're in. So how are you showing on the title to the property, and how are you actually reporting that property on your tax return? There are so many cases right now where the title does not match tax reporting. In a 1031, tax reporting trumps vesting, because this is a tax code. So it's important so now we're going to go back to the CPA. When you're talking to your CPA or your tax advisor before you sell the property, confirm that, okay, how have I been reporting this property on my tax returns? And then go see how you're holding title to that property. Does it match? Does it match? If it doesn't, okay, now the question is, did the tax ownership, is it different than the vesting? So for example, if you have, if it's a husband and wife, for example, and they bought the property as husband and wife, so when they originally acquired the property, they had it in their names. Somewhere during their ownership of the property, they went and they created an LLC that was taxed as a partnership. But they never changed the vesting on the title. Now they go to sell the property, we're out of sync. I have tax reporting, that's an LLC, but I have ownership on the property as individuals. It doesn't match. So you really want to have this stuff match before you get under contract with a buyer, because in the 1031, tax reporting is going to take precedent over the vesting. So make sure that this matches. If you get this done before you even list it for sale, that's going to make this a lot smoother going forward. A lot of times we start running into these issues when people are already in contract, and then if they waited to the last minute to set up the exchange, now we're in a panic because it's not matching. Everything it should be matching at the conclusion of all of this. So really important to make sure that the tax ownership is going to be matching to the vesting on the property. And this also brings to mind that when you're considering this and you're selling your investment property, you know, think about what has to happen when you're buying the replacement property. So when I'm selling the property and I'm selling it in, for example, as an LLC, that's a partnership. Now I'm going off to buy a new property. You need to check with your lender about that, because this is important, again, to the success of the exchange. Am I going to be able to get financing in that LLC? These are issues that come up in the 1031. So when you do a 1031, same taxpayer selling has to be the same taxpayer purchasing. Now, sometimes the vesting may be a little bit different, but then what you've had, but all of it, but your tax reporting is the same. So might be an instance where you created an LLC as a disregarded entity, so it was there for liability purposes. And then let's just say that you never bothered to put the property in the LLC, but you've got the LLC. That you're still the same taxpayer, so that's not an issue. When people are buying on the replacement property side, they may have sold as an individual, but they want to buy in an LLC for liability protection. As long as the LLC that they're creating doesn't change the tax ownership that they sold out of, that works for a 1031. So important things to be thinking about when you're going onto these kinds of transactions. It's critical to try to get this stuff lined up, so when you're getting involved in the 1031, you're trying to hedge all the obstacles, you know, that's maybe coming at you. So again, really important to understand, is your tax ownership accurate to your vesting? If I want to buy replacement property, how can I do that and still maintain the exchange? All right, very, very critical.
Dino, I've gotten this question from some investors
Sure.
before in the past. Maybe they own a property jointly with a partner or a family member, and the family member wants to cash out and take their money, and the other person wants to 1031 exchange and not pay the tax and roll it into another investment. Every time I get that question, I go, call Dino and talk with her about it. But while I have you on here, what is the fix in that scenario?
Okay, so the question would be, I would ask you, if somebody came to me, I say, well, how are you reporting the property on your tax returns? So you can have co-ownership, but you're reporting your respective interests separately, in the sense of you have an undivided fractional interest. So say, for example, Leah, you and I had a property together, and we went out and we bought this property, and say, you know, our split, our undivided interest is maybe you have 60%, I have 40%. And we're reporting it that way on our tax returns. Then when we go to sell that property, you can go your way, I can go mine, because I have an undivided fractional interest. In other words, I don't own your 60%, you don't own my 40%. So that's not a problem. Here's where the problem comes in. Say you and I created an LLC, okay, we'll call it the LD LLC, where you're a 60% member, I'm a 40% member, but we're treating this as a partnership. So the partnership itself is filing 1065. You and I are getting K1s. In that instance, when we're sitting in escrow right now, or under contract to sell, and you go, okay, Dino, it's been great. We've had a fun ride. I want to go buy something myself. And I say, fine, no problem. You know, all good. Still love you. All right. You know, guess what? We can't, because the partnership interest does not own the property. The LLC is the taxpayer that owns the property. So here's where it gets really dicey. How do I do this where we can go our separate ways? Well, again, gets back to that planning, right, ahead. So if we decide maybe like a year before we're going to sell the property, go, okay, we're thinking, all right, let's sell the property in a year where the market looks like it's good to do that, but I want to go my separate way, you want to go your separate way. So now what we have to do is we have to now dissolve that partnership. Then we have to take title as tenants in common. You want to create all the proper documentation for all of this. Then we want to season that for a period of time, because we want to be able to show that our intent was still to hold that property for investment purposes. Regrettably, a lot of this happens when people are sitting in escrow under contract with a buyer. That's not your ideal time to do that, to do the drop down. So you want to make sure, if you're going to be doing something that risky, that your tax advisor, back to that person again, is on board with what you're doing. If your tax advisor says, no, I think we can still substantiate this intent, and then says, go ahead, we'll go ahead and do the drop down, then that's between you and whoever does your taxes. Like I've said 1,000 times, you'll never see me with anybody at the audit, okay? Unless it's my own audit, knock on wood, hopefully that won't happen. So anyway, so planning, and more planning when it comes to that situation. And then Leah, also that goes on the buy side, right? So say I sell as an individual, and then you've got this great little syndication that you're putting together, and you go, I'm looking for equity, and I'm going, oh, I've got maybe a couple $100,000, I'd like to join in. So you create an LLC to buy that product, and then you're saying, okay, well, you can put your $200,000 in. I can't buy an interest in a partnership. So it works on both sides of the equation. All right, so I can't buy into a syndication. I can't buy into a REIT in a 1031 because I'm not buying the real property. I'm buying either shares or I'm buying a membership interest. So now if you've created a tenant in common situation, then that's different. So.
Yeah,
okay.
I did see that question come in a little bit earlier. I can't put my finger on it now, but it was exactly that. It's can you do a 1031 exchange from a single family or a multifamily that you own as an individual into a syndication?
No. You have to be an owner of the real estate itself, not a membership interest. So. And then I think the other question, Leah, I believe was on the LLC issues, is somebody was selling in their LLC and they were having difficulty with financing. And as I mentioned earlier, that's why it's so important when you're doing something like this to be talking with the lender, because if you're selling in an LLC that is taxed as a partnership, then that is the entity that has to buy. So you can't go off and say, well, the lender says that I can borrow in my individual names.
Right.
The qualified intermediary is going to be sending exchange documents in the LLC. The escrow officer or the closing attorney is going to be reflecting the closing statement as the LLC. I don't know how the lender funds to something different than they're lending to. So that can be problematic in the situation. And you can't sell in an LLC that's taxed as a partnership, buy in your individual name, and then when you close on the purchase, then you say, oh, I'm going to put it back in the partnership. It doesn't work that way. Same taxpayer selling has to be the same taxpayer purchasing. All the documentation needs to match. It all has to match.
Right.
So what's really important is when I talked about, how much you have to spend for the exchange. And so when that situation comes up, it's important, whether it's a partnership, an LLC, or whether you're holding as individuals, to understand how much you have to borrow and how much you have to spend for your exchange. There can be instances where the investor is borrowing too much, where they're not spending all of the cash. So again, it's really important to know when you're doing this, not to overfinance. Sometimes people want to overfinance in a transaction, and they're not realizing they're not spending all of the cash. So even though they may have purchased higher than what they sold for, if you do not spend all of the cash, then that's going to be a problem for the exchange, unless you go off and buy another piece of property with the excess cash that's still in the exchange. Now, the number 5 tip for a successful exchange: to communicate. It's so important to communicate. And when I'm referring to communication, I'm not just referring to communication with your real estate professional or your lender. I'm also talking about communicating with the 1031 company that's facilitating your exchange. It's important that you as investors are proactive in your transaction. There are a lot of occasions where the investor doing an exchange is leaving it up to the real estate professional, the closing professional, the lender to professional, the qualified intermediary to spearhead their transaction. Well, those four groups that are a part of your transaction, we all have very different roles for the 1031. So you need to be proactive, stay on top of your transaction, know what you've got going on, know your timelines, know when your 45 days is going to be up, know when your 180th day is going to be up. Because if you're negotiating certain prices or you're going into something that may be like new construction, which has been a challenge, for the last year for completing exchanges, you're not going to get into new construction that's got 9 months before it's going to be finished. So know your timeframes. Stay engaged in your transaction. I always like to tell people, when you're getting emails from us, please open them. I promise you, we're not giving you lawn tips nor recipes. Everything that we're going to be sending you is going to be regarding your exchange transaction. We're going to send you notifications. Your 45 days is coming up. We don't have your ID. Be engaged. So if you don't understand the email, this is where the proactive comes in. You pick up the phone and you call and say, what is this email about? What is it you need me to do? When you get, so when you stay engaged and you stay proactive and you know your timelines, that helps smooth out the transaction. It helps smooth out the transaction. So remember, when you're doing a 1031 as an investor, you are electing to do a tax code. All right, it is a tax code. There are some things that that may be workable, and there's some things that are not workable and or fixable. Again, this is a tax code. So just be proactive, know your timelines, please stay engaged. So those are my 5 tips for a successful 1031.
Love it.
Do we have any questions?
Yeah, let's get your contact info up here. The questions are pouring in, so this gives them something pretty to look at here.
I don't know, do I still look like the picture?
Exactly, I feel. Okay, let's work through some of these. Okay, this has been kind of a topic of conversation in the current market because it's such a seller's market. That is the reverse 1031 exchange. It's kind of thrown out there as a good option that kind of relieves some of the pressure of the identification window. But I know that you have some cautionary notes about the reverse 1031 exchange.
Yeah, yes, I do.
Do you recommend these?
Okay, so a reverse 1031, just for those that may not be familiar with it, basically means you have to close. So the operative word there is close on the purchase before you have closed on your sale. So you're doing the exchange in reverse. That's why they call it a reverse exchange. So while they may be available, they're not always doable for every taxpayer that's trying to do that. Because when you're doing a reverse exchange, the qualified intermediary, we have to create an LLC where we're going to park title to the property you're going to purchase. Now, the question is, where are we getting the money to buy that property? Because nothing has sold yet. Your sale hasn't closed. If you have all cash to do the reverse exchange, then that's going to make it easier. Not going to make it less expensive, but it's definitely going to make it easier because you're bringing in all the money to buy the property. Majority of the times people say, well, I have the down payment, but I'm getting a loan to buy it. So when you have the down payment, but you're getting financing from a lender, that is going to make the reverse exchange almost impossible if it's a standard lender. Because when you do the financing for the reverse exchange, the LLC that we create to go on title to the property is going to be the borrower. Now, you're going to guarantee it, but we're going to be the borrower. And then we as a company are going to say, friendly lender, I need you to insert this language into your pre-printed, pre-approved, legalized, blessed documents. How many times do you think a lender is going to do that if they are a lender that basically sells the loan before you even close on the purchase? I would say barely ever. Okay, you're going to have to find either private money, hard money, or some lender that's willing to do that. So that's why reverse exchanges, while they're attractive, especially right now, given the inventory that levels that have been for the last year and a half, they've been a popular topic. Let's go talk about a reverse exchange. It's not, I like to say, it's not for the weak of wallet. They're expensive exchanges. And so therefore you really need to have the funds to do it. If you've got a lender that's going to be involved, you're going to have to find a lender that's willing to play ball. And to me, you have to talk directly to the lender that will be funding, not the mortgage broker, because we've had people in the past say, no, we're fine, we're fine, we're fine. It gets down to the closing of the purchase and the lender goes, I'm not financing to that. And they're at the closing. Okay, so reverses, if you have the cash, it could be a viable option. But when somebody's going down that road, I like to go through the economics of the transaction to make sure it makes sense for them to do a reverse, as opposed to, maybe you're not paying enough tax to even warrant doing a reverse. So they're a lot more expensive transactions.
Yep. But maybe a good option if you have some liquidity.
Yes.
Okay, Hassan asks, is there any recommendation on a 721 exchange? I'm not familiar with that at all.
Okay, so the 721 basically it's like an upreach. So there's like a 721 going into it. Most of the time where I see that is where people are buying into a Delaware Statutory Trust that may turn into an upreach. But when you're just talking about a regular 721, what you're dealing with is that the REIT that's going to ultimately buy your property from you has to really want your property. So they're very rare on the, you usually see them in like DSTs where you're into a Delaware Statutory Trust, which does qualify as like-kind property, and then it springs up into an upreach. So they're not common at all.
Yeah, that was a really timely question. Rory also asked, can we 1031 exchange from a single family home into a Delaware Statutory Trust? We've kind of been kicking that around internally at RealWealth as maybe a good fallback plan potentially to a 1031 if you can't identify sufficient properties. If you've identified a DST, then maybe it's an alternative or a good fallback plan.
Yeah, and that would be accurate. There are people, I mean, when I did my exchange a couple of years ago, I ended up with the fallback position, which was a DST. Okay, so, but a Delaware Statutory Trust does qualify. That is basically sold by a registered rep, so you need to speak to registered reps that sell the product, but it does qualify for like-kind in the 1031. If it's going to be a backup property, remember you have to identify it within the parameters of the 45 days, and you're going to be identifying in percentages because that you're buying a percentage of a larger property. So say for example, the DST sponsor buys something for, $50 million and you're going to put $100,000 in it, where you're only going to be buying like 0.01567889%. Okay, so you're going to be putting in the percentages, but DSTs can be a good fallback. And then there's people that want to go into DSTs because they don't want the management anymore. So
yeah, a little more passive.
Very passive.
Can you do a 1031 exchange for fix and flip? So if you sold a flip, can you then 1031 exchange into a buy and hold?
Okay, so wait, you had two different questions there. So
so if I sell a fix and flip, I want to avoid paying the gain on that. Can I do a 1031 exchange into a single family that I just hang on to?
Okay. All right. So basically you're trying to have the best of both worlds.
Yeah.
All right. So when you're doing a 1031, both the sale property and the replacement property, the purchase property, have to have been held for investment purposes. So while your ultimate goal is to be a holder of property, the entrance to the 1031, you're a flipper and therefore would be considered a dealer. Therefore, the property could be considered inventory and does not qualify for 1031 because the intent with that property is going to be to fix and sell. So even though you're going to have the hold on the other side, did you meet the held for investment intent on the front end? And if you're a flipper, you're going to have a tough time explaining that one if you ever get audited.
Yeah. All right, Eric wants to know where he can find lists of qualified intermediaries. Are they state specific? We have a list on our website. So when you're logged in and go to resources, we've got a couple that we recommend. You'll find Asset Preservation Inc., Dino Champagne's company on there. That's a good place to start. What about his question, Dino, about it being state specific? Does it matter where they're located?
Well, no, it's the 1031 code is a federal code. So you just have to find out is the qualified intermediary. So in other words, if you're selling in Texas, do you have to have a qualified intermediary that's based in Texas? And the answer to that is no, because qualified intermediaries are working, nationwide. So it's not specific because whatever qualified intermediary you start with, that's the qualified intermediary you're finishing with. You can't change qualified intermediaries in the middle. So you just need to ask the qualified intermediary, are they licensed in the state that you're selling out of? Okay. If you wanted to find more out about various qualified intermediaries, you can go to the Federation of Exchange Accommodators. That is our trade group's website. So we're a member of the FEA. So you're going to have qualified intermediaries that obviously are members of the FEA, but not all qualified intermediaries are. So, but you might want to go to that website if you wanted to look for specific, other 1031 companies.
All right, this question you've already kind of covered, but in case it wasn't clear and there's anybody else with a similar question, let's recap. The question is, do you have to replace the same amount of debt as on the outgoing property? For example, if you have a mortgage of $600,000, do I need to have a $600,000 mortgage on the next replacement property or properties?
Okay, so the answer to that question is not necessarily. And if is the big word here, if you are bringing in cash from outside of the exchange to replace that $600,000 mortgage. Because remember, to do the exchange, you have to buy property equal to or greater than your sale price, spend all the cash and replace the debt. So if your goal is to only spend the cash and not replace the debt at all, okay, then you're buying less than what you sold for. But if you're spending all the cash, but you want to bring in additional funds, so if you wanted to bring in $600,000, then yes, that would work.
Yep.
But if you're not replacing the debt at all and buying less than what you sold for, then that would be considered mortgage boot and taxable.
Right. You could also get more debt if you can qualify for it. You could lever out the equity you have beyond the $600,000, but of course you have to qualify for the mortgage.
Yes. Mm-hmm.
Okay, this one sounds a little complicated, but what if we purchased under both of our names? We aren't married, we file separately, but we're getting married later this year, and we will file jointly on the year of sale. What happens then?
Well, they get married. They're going to be filing jointly when they're married, but when they're selling, are they married? Did you say that? Are they selling separate?
I don't think they've sold yet. I think that they are acquiring the property separate when they're not married, filing separately. While they own the property, they're getting married, and now they're filing jointly. So now, 5 years from now, 10 years from now, they're going to sell it. What happens then?
Okay.
Very specific.
Yeah, that's one of those, the tax reporting doesn't match the vesting, right? Because now you're filing a joint return where before, when you were single, you were filing a separate tax return. Talk to your tax advisor about, how do you solve this problem? All right. There's probably not going to be one, but I can't say for sure. It depends on the state that you live in. So, because there's community property states and there's states that are non-community property.
Yeah.
So if you now, if you're in a non-community property state, you acquired the property separately, talk to your tax advisor about how to get that to match before you put the property on the market for sale.
Yeah, it's a good question. There's a lot of nuances. I mean, again, to your pro tips, Dino, you got to get the right people involved who kind of can sink into your specific situation and steer you straight.
Yeah, and one of the reasons why it's so important not to just get your tax advice from the cocktail party or barbecue, that you're talking to your tax advisor, talking to the qualified intermediary, because everybody's exchange transaction is going to have a slight nuance to it, which could make all the difference in the world as whether it's going to be successful or not.
Yep. Yep. Do you avoid state taxes with a 1031 exchange?
Depends on the state. There are some states that, for example, I'm in California, so California mirrors the 1031 code. So if you're selling in California, you can exchange out of California into another state and still defer California tax. You're going to have a reporting requirement in perpetuity until you pay California the tax that you deferred when you sold. But there are certain states like Pennsylvania and Georgia that you may want to look to. So any state that you're selling out of, I would say look to the state law to see whether they comply with the 1031 code. If they do, what are the restrictions associated with it? If there's any kind of withholding a document that may come in, because there are certain states that have withholding documents that you have to sign prior to the closing. So whatever state you're selling into, you're going to selling out of rather, you need to just see what is that, what does that state do? So if you're selling out of a state that's non-income tax, and then that's easy, no state tax.
Good answer, Dino. You let me check off like 3 or 4 questions in that answer. Okay, if selling or purchasing in personal name, how long must the property be titled that way before transferring it into a disregarded LLC?
Oh, you can buy in the disregarded LLC, because a disregarded LLC, and sometimes people get the term, they trip up with it a little bit. The term disregarded means that the LLC is not its own taxpayer. Everything flows, so it's a disregarded entity for federal tax purposes. So everything flows to your personal tax ID number. So if you're selling out of a property in your individual name, and you wish to acquire the replacement property in that LLC, and if your lender is willing to lend to the LLC, because this happens also with trusts, people's revocable trusts, you can close on the purchase to the replacement property in that LLC, because it's going to say Joe Seller acquiring property under the JS Investment LLC. All right. So as long as that LLC is disregarded, you can buy immediately into that, because it's still you.
Right. All right, this question comes up every time the executive branch turns blue. I've read that Biden is trying to set limitations on 1031 exchanges. What do we know, and how likely is there to be a change that makes the 1031 exchange less effective?
Well, right now we're on the sidelines, so that's good. You never know what Washington's going to do. In the last round, I think it was if I remember all the BBB, Build Back Better plan, whatever, we were actually even removed from that discussion. So it doesn't mean that in the future it couldn't come back again, but I can promise you as an industry, we're watching it closely, and we're advocating to make sure that 1031s are pretty much left alone, because 1031s are a viable part of the tax code that helps grow the economy in various ways. So, and it's not like somebody when you're doing a 1031, you're continuing the ownership of a property that you already had. So you're not, and if you touch any money, you're going to pay tax on it. So so that's the thing with the 1031. It's a continuation of ownership. So right now we're safe, and hopefully we'll remain that way. But we're watching it obviously as an industry, so we'll see what's coming out. I haven't heard any recent rumblings, but anything can change at any time.
Right. Not the first time it's been up for discussion.
No, not at all.
Okay, Robert asks a specific question here. He says, I'm invested as a passive investor in a multifamily syndication. They're selling the property and they want to know if we want to stay in using a 1031 exchange or cash out and receive all the cash. What should I do or ask the sponsors before proceeding? I mean, there's probably a long list of questions that you should ask, but maybe in your lane, Dino, what would you be asking?
Well, there's not much you can ask in that because he's very limited. Either you're going to go with them. So the LLC, the syndication is going to do the exchange. Okay. And you're still staying in that syndication, or you're going to, they're going to pay you out and you're going to pay the tax. There's not a lot of room there.
Yeah. So your questions all need to be about the replacement property, learning and doing your due diligence on the next investment.
Well, there's no replacement property at that point. Yeah, if they're going to be buying, what are they buying? Do you want to go in with them to what they're buying? That might be a legitimate question. Yeah.
Right. Right. Okay. Let's see here. What happens to the old basis and new basis for the property? Do we get a blended basis?
All right, when you're doing a 1031, you might get a blended basis depending on how much you buy for. So let's just try to keep this simple. If I am selling an investment property and my old basis is say 200,000, that means my gain is 300,000. If I buy a replacement property that is 500,000, so basically what I sold for, my new basis in the property is going to be what I paid for it minus gain deferred, which is going to be the 200,000. If I buy something for, say, $1 million, now I'm going to have an old basis, and then I'm going to have an increase because of the new value that I added to that transaction. Gets really interesting at that point. This is a good topic when people have owned a property for a really long time and their depreciation is now coming to an end. So if you're at, say you're selling a single family rental that you've had for 25 years, you're running out of time for depreciation. If you buy equal to what you sold for, in 2.5 years, you're done with depreciation. But if you buy a lot higher, then while that old depreciation tracking with the old basis is going to fade away, there's going to be a new depreciation schedule for the new portion to the extent that that new portion is real property.
Interesting. So it kind of behooves you to try to scale up maybe a little bit as you continue to purchase.
Definitely. If you're at the end of your depreciation schedule, I mean, if you're at 5 years in, maybe not, but
right.
If you're toward the end of it, definitely.
Right. Well, you hear these stories all the time. I mean, it's one of the selling points to real estate is, it's a great vehicle to pass on wealth to your heirs without ever paying tax on any of your gain. Just 1031 exchange until you die, right?
Mm-hmm. Yeah, well, we still have the step up in basis, yes.
But it can get kind of complicated, I'd imagine, to follow. If you've done multiple 1031 exchanges over and over and over again, it seems like it could get kind of tricky to track.
Well, it can, but that's what the accountant's doing when they're filling out the 8824 form.
Dino, are you with me?
Yeah, I'm here. I'm still
here. Go ahead.
Here.
Sorry, there was a bit of a delay. I hear you.
Oh, okay. Yeah. That's why the accountant has to fill out the 8824 form, because all that stuff keeps tracking. So, another reason that if you're, to talk to your tax advisor when you're talking about selling, because if you just go to a qualified intermediary and say, well, I bought this property 2 years ago for 500,000 and I'm selling it for 550. I know that's not the market today, but if I'm selling it for 550, gee, do I really need to do a 1031? And the answer is, I don't know. Did you exchange into the property for the first 500,000, and if they say yes, then now remember, your gain has been deferred in all prior transactions. So, they have to track all of that. They do that with the reporting.
Yeah. All right. So there's a couple more questions, but we're getting really specific. People are seeing how knowledgeable you are, Dino, and they're wanting to drill into their specific situation. Bless you. You entertain these all day long, I'm imagining, or could. The last question that we'll end on is this. It is, what are the intermediary costs for a regular 1031 exchange, and if there's a difference for reverse 1031 exchanges?
Well, yeah, there is a big difference. The 1031 costs, and I like to take that question offline because fees change as time goes by. And reverses are quoted basically by the transaction. I will tell you, reverses are thousands more than the regular forward exchange. So more than happy to entertain the cost question, because it's going to vary on how many properties you're buying, that sort of thing. So, if you want there's my contact information, please feel free to reach out to me and I'll give you specific pricing on and quotes on both, but it's kind of, it's general. Every qualified intermediary has different fees.
Right. All right, Dino. Well, I'm so appreciative. Go to the next slide for me. I'm not sure if it's our closing slide or not. Well, there we go. Hit one more. There we go. Okay, Dino, you are a wealth of knowledge always. I haven't done a 1031 exchange yet, but I feel ready for one based on just my proximity to you. So really appreciative of your expertise and for being just a continued resource for us and for our investors. Thanks so much for taking the time out today.
My pleasure. Thank you for having me.
Real quick, before I sign off, I want to give a plug for everybody watching live. We've got our live event happening in Tampa. It's next weekend. There's still a couple spots available for registration. So if you've been thinking about joining us for our live event in Tampa, this is fate telling you, sign up, come meet us, come meet the team. I think we're gonna have 11 or 12 of the property teams all there giving presentations. Rich and Kathy are gonna be there. It's gonna be a great casual hangout. So be sure that you register for that. You can find the link on the investor portal. So log in to your account and you'll see the registration button there with additional information. I hope to see you guys there. All right, Dino, thanks again for joining us. We'll see you.
My pleasure.
Bye.